Imagine waking up one morning to discover that your entire life savings had vanished overnight. Not stolen by criminals, not spent foolishly, simply gone, evaporated into thin air. This wasn't a nightmare scenario. This was the harsh reality for millions of American families on October 29, 1929. But here's what the history books won't tell you. The greatest economic catastrophe in American history wasn't caused by some abstract market force or an inevitable economic cycle. It was triggered by the deliberate decisions of one ambitious banker who genuinely believed he was saving the world from financial disaster. His name was Charles Edwin Mitchell. Wall Street knew him as the president of America's most powerful bank. The newspapers called him Sunshine Charlie. And this is the untold story of how one man's vision of financial democracy became America's darkest economic nightmare, destroying the lives of an entire generation. The American economy was growing at a pace that seemed almost magical before the greatest economic catastrophe. Industrial production had more than doubled since 1919. Factory wages were rising steadily. Unemployment was remarkably low. New technologies were emerging every single month. Electric refrigerators, vacuum cleaners, washing machines, motion pictures with sound. America wasn't just participating in the modern world. America was inventing it, piece by piece. But beneath this glittering surface of prosperity and innovation, something fundamental was beginning to change in how ordinary Americans thought about money, wealth, and their financial futures. And that change would prove catastrophic. Charles Mitchell didn't look like a revolutionary figure who would reshape American finance forever. He certainly didn't look like someone who would trigger an economic apocalypse. Mitchell came from modest middle-class roots. His father was the mayor of a small town, respectable, but hardly wealthy or powerful. Nothing in young Charles's background suggested that he would one day control more money than most nations, or that his decisions would affect the lives of millions of people. But Mitchell possessed something that set him apart from his contemporaries. An unshakable, almost messianic belief that he could see the future of finance more clearly than anyone else. He understood something profound about human psychology, about dreams, about greed, about the deep American desire to rise above one's station through cleverness and opportunity. By 1916, Mitchell's talents had caught the attention of National City Bank, the largest and most prestigious financial institution in America. Within just 3 years, at the age of 42, he became its president, one of the youngest men ever to control such vast financial power. National City Bank wasn't just big. It was with assets totaling $2.7 billion. It controlled more money than the entire GDP of most countries in the world. Its imposing headquarters towered over Wall Street like a massive stone cathedral dedicated to capitalism itself. When National City Bank spoke, the entire financial world listened carefully and obeyed. But Charles Mitchell had identified what he believed was a massive problem, or rather, what he saw as an enormous opportunity that every other banker was somehow missing completely. In 1920, the American stock market was an exclusive, closed club. Only about 500,000 Americans owned any stocks at all, less than 0.5% of the total population. Think about that stunning statistic for a moment. In a rapidly growing nation of 106 million people, virtually no ordinary citizens participated in the ownership of American businesses. Why was participation so limited? because the entire system was deliberately designed to keep regular people out. To buy stocks, you needed to visit a brokerage house, intimidating buildings made of marble and granite, located in financial districts, where wealthy men in expensive three-piece suits spoke in mysterious financial jargon designed to confuse outsiders. You needed substantial capital just to begin. Most stocks cost hundreds of dollars per share, at a time when the average American worker earned perhaps $1,500 for an entire year of hard labor. You needed personal connections, specialized knowledge, and the social confidence to navigate a world that actively didn't want ordinary working people involved. The wealthy elite actually preferred it this way. Stock ownership was considered a gentleman's pursuit, like playing polo or sailing yachts. Activities meant only for those born into the right families. The very idea that a factory worker or a small shopkeeper might purchase shares in US Steel or General Electric was considered not just unlikely, but absurd, even vaguely dangerous to the social order. But Charles Mitchell looked at those numbers with completely different eyes. Where others saw tradition and proper social boundaries, he saw 105.5 million potential customers with money burning holes in their pockets. In 1920, Charles Mitchell made a decision that would fundamentally change American finance forever. He created a subsidiary company called National City Company with one clear, singular purpose: to sell stocks and bonds directly to ordinary middle-class Americans. This approach was genuinely revolutionary, almost shocking to traditional bankers. Banks had always taken deposits from customers and made loans to businesses. Separate investment houses sold securities, but only to their wealthy clients. Mitchell was going to completely blur these traditional boundaries. His public vision sounded noble, even democratic and patriotic. Every American should be a capitalist, he declared to newspapers. Why should wealth-building opportunities be reserved exclusively for those who already have wealth? This is America, the land of opportunity. On the surface, this message resonated powerfully. Mitchell genuinely seemed to believe he was leveling the economic playing field, giving hard-working regular people access to the same wealth-generating financial tools that had made families like the Rockefellers and Morgans fabulously rich for generations. But there was another motivation that Mitchell discussed less publicly with reporters. National City Company would generate absolutely enormous fees from every stock sale. And those fees would flow directly into the pockets of Mitchell and his shareholders. The more stocks they sold, the more money they made, regardless of whether those stocks ultimately went up or down. The genius, or perhaps the fatal danger, was in exactly how Mitchell planned to make this revolutionary system work in practice. Mitchell didn't just want to sell some stocks to some people. He wanted to create an entire movement, a fundamental shift in how Americans thought about investing and building wealth. He started by transforming all 69 National City Bank branches scattered across America into something unprecedented in banking history: combined banking and investment centers under one roof. When a farmer came in to deposit his seasonal crop earnings, a friendly salesman would be waiting to suggest he invest in the bright future of American business. When a school teacher came to cash her monthly paycheck, she'd be offered a golden opportunity to own part of American Telephone and Telegraph, the communications giant connecting the nation. But Mitchell understood human psychology deeply. He knew that ordinary people wouldn't just buy stocks simply because they were now available. They needed to be sold. They needed to be persuaded, educated, and inspired. And truly effective selling required something that conservative banking had never attempted before: sophisticated mass marketing. Mitchell hired hundreds of salespeople and put them through intensive training programs. These weren't the stuffy, formal bankers of previous generations. These were dynamic, persuasive men and women who learned to sell dreams and futures, not merely financial securities. They were taught to identify what psychologically drove each individual customer. For young couples, it was securing their children's future education. For middle-aged men, it was proving they were successful providers. For widows, it was achieving financial independence from their children's charity. The sales training was remarkably sophisticated for its era. Every possible customer objection had a carefully scripted, psychologically tested response. Customer: "But I don't understand how stocks work." Salesperson: "That's exactly why you need our expert guidance. We'll guide you through every step." Customer: "I can't afford to invest." Salesperson: "That's the beauty of our convenient payment plan. Just $15 monthly, less than you probably spend on entertainment." Customer: "Isn't the stock market risky?" Salesperson: "The only real risk is missing out on this opportunity." American business has never been stronger or more innovative. The advertising campaign that Mitchell launched was unlike anything America had ever seen before. Full-page newspaper advertisements showed ordinary people achieving extraordinary financial success. From stenographer to shareholder, how Sarah built her fortune. Read one headline featuring a well-dressed young woman standing proudly in front of her beautiful new home. He was just a shop foreman. Now he's building his family's fortune through smart investing, declared another, showing a confident man with his wife and children. Popular magazines ran inspiring articles, many secretly paid for by National City, though this financial relationship wasn't disclosed to readers, about the exciting emergence of a new investor class in America. Radio programs featured success stories of ordinary people who had built wealth through stock investments. Even church bulletins carried advertisements suggesting that prudent investing was part of good Christian stewardship of God's gifts. The message was everywhere, constant and consistent. Investing in stocks wasn't dangerous speculation or gambling. It was patriotic. It was wise. It was modern. It was the American way forward into prosperity. But Mitchell's real innovation, the revolutionary mechanism that would ultimately doom millions of families, was making margin trading available to ordinary people. Here's how this system worked. Traditionally, if you wanted to purchase $1,000 worth of General Electric stock, you needed to have $1,000 in actual cash. Simple, straightforward, safe. Mitchell completely changed these rules. Under his revolutionary new system, you only needed $100 in cash. National City Bank would happily lend you the other $900, using the stocks themselves as collateral for the loan. The mathematics seemed almost magical to ordinary people. Let's say you bought $1,000 worth of Radio Corporation stock, putting down only $100 of your own hard-earned money. If the stock price rose by just 20%, your shares would now be worth $1,200. You could sell immediately, pay back the $900 loan, and walk away with $300 in profit. That's a 200% return on your original $100 investment. Money making money. Mitchell's salespeople would literally sketch out these calculations on napkins in bank lobbies, making it seem simple and foolproof. See, Mr. Henderson? Your modest $100 becomes $300 in just months. That's the incredible power of leverage working for you. What they didn't emphasize strongly, what many didn't fully understand themselves, was that leverage worked equally powerfully in both directions. If that same stock fell by just 11%, your $1,000 investment would be worth only $890, less than the $900 you owed the bank. You wouldn't just lose your original $100 investment. You would actually owe the bank additional money. And if you couldn't pay immediately, the bank would sell your stocks at a loss, possibly sell other assets you owned, and still demand payment for the remaining difference. But in 1925, 1926, 1927, stock prices weren't falling. They were soaring higher and higher every month. And that remarkable success made all the careful warnings from conservative bankers seem like the bitter complaints of old men who simply didn't understand the exciting new economy. In 1925, National City Company sold $500 million worth of securities to eager investors. By 1927, that figure had tripled to $1.5 billion. The company was opening new offices at the remarkable rate of one per week. Competitors scrambled desperately to copy Mitchell's successful model. Within 3 years, nearly every major bank in America had created similar investment subsidiaries. The number of Americans owning stocks exploded from 500,000 in 1920 to over 4 million by 1928. And the number was accelerating rapidly every single month. But something else was happening. Something that Mitchell either didn't notice or deliberately chose to ignore. The profile of these new investors was changing dramatically. In the early days, Mitchell's customers were still relatively well off. Doctors, lawyers, successful merchants who could afford to take some risks. But by 1927, the aggressive salespeople were reaching further and further down the economic ladder. Factory workers were taking out loans against their homes to invest. Domestic servants were pooling their modest savings. School teachers were mortgaging their houses to buy stocks recommended by trusted bankers. These weren't greedy speculators looking for quick riches. They were ordinary, hard-working people trying desperately to secure their futures, trusting completely that the experts at America's most prestigious and respected banks knew exactly what they were doing and had their best interests at heart. And stock prices kept rising, seemingly without limit. Radio Corporation of America started 1928, trading at $85 per share. By September, it had soared to $420. General Motors climbed from $140 to $225. US Steel rose from $138 to $279. Everyone who had invested was making money, lots of money. And everyone who hadn't yet invested was watching their friends, neighbors, and co-workers getting rich. The psychological pressure to join in became absolutely overwhelming. By early 1929, even some of the most optimistic professional economists were beginning to worry seriously about the market's direction. Stock prices were rising much faster than the actual underlying economy or corporate profits. The Federal Reserve began sounding alarm bells. The numbers were genuinely frightening to anyone paying attention. Major company stocks were trading at prices 15 times their annual profits. Ratios that experienced investors recognized as signs of dangerous speculative bubbles. on February 6, 1929, the Federal Reserve issued a stern public warning to all member banks. Immediately stop issuing loans for speculation in the stock market. The central bank demanded strict limiting of margin lending. The market's reaction was immediate and severe. In March, stocks began falling sharply. In just a few days, American investors lost billions of dollars in paper wealth. Real panic was growing rapidly. It seemed the bubble had finally burst. And then, on March 12, 1929, Charles Mitchell made the single decision that would change the course of history and seal the fate of millions. Mitchell called an emergency press conference. Reporters crowded into National City Bank's ornate conference room, expecting perhaps a routine reassurance. What they received instead was a bombshell that would echo through history. Mitchell stood confidently before them and spoke words that newspapers would print in massive headlines. National City Bank will provide the market with all the liquidity it needs. We will not allow an unnecessary crisis to develop and damage American prosperity. The fundamental business of this country is sound and prosperous. The effect was immediate and dramatic. The next morning, newspapers across America carried Mitchell's defiant statement. The New York Times headline screamed, "Mitchell defies Federal Reserve, promises unlimited credit." Stocks that had been falling suddenly reversed course completely. Within 1 week, the market had recovered all its recent losses and surged to new record highs. Mitchell was hailed as a conquering hero. "Sunshine Charlie saves the market," proclaimed grateful headlines. Small investors who had watched their savings evaporate sent him thank you letters. But Mitchell's defiance carried consequences that few people understood at the time. He had essentially told America that warnings didn't matter, that the banks would always step in to protect investors, that you couldn't possibly lose. That message would prove catastrophically wrong. After Mitchell's intervention, the market entered what historians would later call the terminal phase of the bubble, the final explosion of irrational exuberance before the inevitable crash. From March through September 1929, stocks climbed relentlessly to absurd heights. The Dow Jones Industrial Average rose from 300 points in March to 381 in September, a 27% gain in just 6 months, disconnected from any economic reality. The market had become pure momentum, pure emotion. Stock prices rose simply because they had been rising, and everyone believed they would rise forever. Shoeshine boys discussed hot stock tips with their wealthy customers. Taxi drivers recommended investments to passengers. Housewives formed investment clubs where they pooled money to buy shares together. But while small investors rushed in with their life savings, a different group was quietly heading for the exits. Professional investors, the people who managed money for universities, insurance companies, and wealthy families, had seen boom and bust cycles before. They understood that markets driven by borrowed money and raw emotion, rather than business fundamentals, never end well. Joseph Kennedy, a ruthless Wall Street operator who had made millions in various schemes during the 1920s, later claimed he knew it was time to get out when his shoeshine boys started giving him stock tips. Whether that specific story is literally true or not, the principle was sound. When even the least financially sophisticated people are speculating wildly, the market has run out of new buyers. Kennedy began selling his holdings in summer 1929. He did it slowly and carefully, not wanting to spook the market prematurely. By September, he had converted most of his portfolio to safe cash. Other smart institutional investors quietly did the same. They didn't announce their moves publicly. That would have triggered immediate panic. They simply stopped buying and gradually sold their shares into the market strength. But for every share these professionals sold, there was an eager small investor ready to buy at inflated prices. One of the largest transfers of wealth in American history was happening in plain sight, and almost nobody realized it. On September 3rd, 1929, the stock market reached its absolute peak. The Dow Jones closed at 381.17 points, a level it wouldn't see again until 1954, a full 25 years later. But nobody knew it was the peak. Everyone still expected the boom to continue forever. The morning of October 24th started poorly and deteriorated rapidly. Prices opened lower and immediately began falling faster and faster. Within an hour, the decline had accelerated into something that looked like genuine panic. By 11 a.m., the ticker tape, which printed stock prices on long paper strips, was running 2 hours behind actual trading. Brokers and investors had no idea what stocks were actually trading for. They only knew with certainty that prices were falling. The telephone lines into Wall Street became so completely jammed that calls couldn't get through at all. Communication simply broke down. By noon, crowds gathered outside the New York Stock Exchange to see if rumors of a crash were true. Inside the exchange, the scene was absolute chaos. The noise was described as physically deafening. Hundreds of men screaming buy and sell orders simultaneously. Some traders literally couldn't speak by day's end. They damaged their vocal cords from hours of screaming. The volume was staggering. By the closing bell, 12.9 million shares had traded, nearly 3 times normal daily volume. The systems simply weren't built to handle that much frantic activity. At 1:30 p.m., the leading bankers of New York held an emergency meeting and agreed to pool resources to buy stocks and stabilize the market. It worked, temporarily. Prices recovered somewhat. Charles Mitchell was part of that meeting. He told reporters afterward, "This is just a technical correction. The fundamentals remain sound." He was catastrophically wrong. Monday, October 28th, brought disaster. The market fell 13%, the largest single-day percentage decline in history. The bankers' pool tried to support prices again, but their buying was overwhelmed by tsunami waves of forced selling. Tuesday, October 29th, was apocalypse. The market opened in complete free fall. 16.4 million shares traded. The Dow fell another 12%. In just 2 days, Monday and Tuesday, the market lost 25% of its value. Approximately $30 billion in market value had simply evaporated into thin air. But the dry numbers don't capture the human reality of what had happened. Behind every point lost on the Dow were thousands of destroyed lives and shattered families. The mechanic from Detroit, who had invested his life savings of $5,000 into Ford stocks, found they were now worth less than $1,000. And he still owed the bank an additional $3,000 that he simply didn't have. Unable to face his family's ruin, he took his own life. The school teacher from Ohio, who had mortgaged her parents' home to buy Radio Corporation stocks, received a foreclosure notice. 3 generations of her family lost the house they'd lived in for 40 years. The widow, who had invested her late husband's $3,000 life insurance payout, saw it shrink to $400. At 58 years old with no income, she faced destitution. These weren't isolated tragedies. They were happening simultaneously to millions of families across the entire country. Black Tuesday wasn't the bottom. It was just the beginning of a long, grinding fall that would last years. The stock market continued declining relentlessly, not in spectacular crashes, but in steady, soul-crushing descent. Every rally failed. Every hope was crushed. By July 1932, the Dow stood at 41 points, 89% below its 1929 peak. 9 out of every $10 invested had vanished. But the stock market crash was merely the trigger for something far worse: the Great Depression. The crash destroyed confidence completely. People stopped spending. Businesses laid off workers. Those workers stopped spending, causing more business failures. Banks that had made loans for stock purchases couldn't collect. 5,000 banks failed by 1933, wiping out 9 million savings accounts. Unemployment exploded from 3% to 25%. 1 in 4 Americans who wanted work couldn't find any. Tent cities called Hoovervilles appeared in every city. Bread lines stretched for blocks. In 1933, Mitchell was called before Congress to testify. When asked if he felt responsible for millions of ruined families, he replied coldly, "I provided an opportunity." What they did with it was their choice. The public was outraged. This man had made $1.2 million in 1928 while encouraging ordinary Americans to take risks he himself avoided. Mitchell resigned in complete disgrace. Sunshine Charlie became the hated symbol of Wall Street greed and fraud. The Depression forced America to completely rebuild its financial system with new regulations. Glass-Steagall separated banking and investing. The SEC regulated markets. FDIC insured deposits. These reforms worked for 70 years, until 1999, when Glass-Steagall was repealed. In 2008, the system crashed again. Today, 50 million Americans trade through smartphone apps. Margin debt exceeds $900 billion. Social media influencers push meme stocks. Apps promise democratized finance. The warning signs are identical. Historic valuations, zero-profit companies worth billions, cheap credit fueling speculation. Every generation believes this time is different. But the pattern repeats. Prices detach from reality. Borrowing becomes unsustainable. Ordinary people get hurt. Charles Mitchell died in 1955, never acknowledging his role in the catastrophe. His legacy lives in every margin account and promise of easy wealth.